This interview is sponsored by Grantstone Shoes. Grantstone Shoes is a third-generation family of shoemakers that uses high-quality leather to make very high-quality men's dress shoes and boots at affordable prices. Mo and I each have a pair of these shoes. We think they're good. We've been wearing them for over a month now, trying them out. If you don't believe us, go check out the customer reviews for Grantstone Shoes. They have a lot of 5-star customer reviews. They also have excellent reviews from independent fashion bloggers. And if you like the shoes, enter promo code GOLD, that's GOLD, on the grantstoneshoes.com website for 10% off your order. That's grantstoneshoes.com, enter promo code GOLD for a 10% off discount. Hi everyone, it's Jason Biarek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years of experience investing in the resource industry. He's a credit analyst, and he's president and CEO of Sprott U.S. Holdings. Rick Rule, thank you for joining me again.
A pleasure, Jason. Thank you for having me.
Now, Rick, when I was up in Toronto in September at your Sprott event, I saw you on BNN, and they were asking you questions, listeners were asking you questions, and the anchors were asking you questions about the oil market. You said you were short-term bearish, long-term bullish on oil in September. Do you think OPEC has a lot to do with that call, or do you think the oil market still has some painful adjustments to do?
I think the answer to that is yes and yes. The rise that we saw in the oil market a couple of months ago was, I think, due to oil consumers' incorrect sense that the cartel had the ability to defy the market, constrain supply, and raise the oil price. The market won. The truth is that there are too many diverse interests in OPEC. The Saudis versus the Iranians is an example. Both the Saudis and the Iranians versus the Russians as another example. The need of the Iraqis to re-enter the market. For the cartel to be able to prop up oil prices in the absence of an uptick in worldwide economic growth and hence oil demand. So in fact, both your statements are true. It was due to the market, but also due to the perception that OPEC might actually work this time, which was a misperception.
Yeah, I agree with you. I think OPEC has a very poor track record of getting what it wants done. I mean, they thought they could bankrupt the shale oil producers if they knocked the oil production, they knocked the oil price down at $65 a barrel. They were convinced that they would bankrupt all the shale producers, and that hasn't happened. And the OPEC on their quota system, which is a cartel, they all have been cheating off their quota system, or almost all of them, for a very, very long time.
That's the nature of all cartels and rigs. The truth is that people who conspire against other people conspire against each other too.
Yeah, that's a great point. But when I look at the supply-demand fundamentals of the oil market, I'm not quite sure if demand has fallen that much, although the global economy has slowed down. But when I look at the supply picture, you brought up how a bunch of different countries, whether it's Iran, Iraq, Libya, Nigeria, some Canadian oil sands producers, when the oil price drops, Rick, instead of cutting production, they seem to want to increase production. We have Russia and Saudi Arabia not cutting production. We have them running basically at max capacity. So it's kind of defying the logic for some people to look at the oil market.
Well, the Russians flat need the cash. That one's easy to figure out. To the extent that they have the ability to rob future years' production by increasing production without too dramatically increasing sustaining capital investments, they'll do it because they need the cash. The Saudis just got tired of creating a price umbrella that allowed less effective competitors to gain market share in the market. And they also are locked in a fairly bitter dispute on many fronts with the Iranians. Iranian production had of course been constrained by sanctions, and when the sanctions came off, the Saudis were loath to give up market share to people who they believed would use the cash generated by the market share against them. The Saudis did believe that many of the technologies that have emerged that have allowed marginal producers like the United States to become larger producers happened as a consequence of the pricing umbrella at $90 that was partially a function of Saudi production constraint. And so the Saudis decided to stop subsidizing other competitors.
Yeah, that makes sense. Now, I want to ask you about free cash flow in the oil industry, since you have a long track record of looking into the oil industry and researching and investing in there. Are a lot of the oil companies at the current oil price, are they actually generating free cash flow? Have they been able to cut costs, or are they basically just treading water, barely able to make up debt payments, trying to raise equity and hoping that the oil price will continue to rebound?
Well, that's a nuanced question. There are a fair number of producers that make money against their cash lifting costs. Uh, that isn't the same as full cycle profitability. There are many sustaining capital investments around the world that are not being made. Pemex in Campeche and PDVSA in Maracaibo, Mexico and Venezuela, respectively, are classic examples of producers that are generating cash simply based on the lifting costs, but they're not amortizing sunk capital expenditures, and much more importantly, they're not making sufficient sustaining capital investments to maintain their production going into the future. So the answer is, in one sense, yes and yes. There are a small number of producers in very high quality shale plays in the United States that can generate free cycle free cash at $50 crude, particularly if you keep it company with $2.50 dry gas, the situation that we had until very recently. But it's interesting that the way that the oil and gas industry reports their costs, similar to the mining industry, if companies have written down their reserves, which many of them have in the last 5 years, their depreciation and depletion numbers take place from the lower base. In other words, they don't count as a cost the $5 or $6 billion in prior year write-downs that they took. So when they talk about all-in costs, they're all in except for the $5 or $6 billion that they sent to money heaven with write-downs. Odd accounting from my point of view.
That's very interesting. When I look at investor presentations for oil companies, I actually don't see a lot of all-in sustaining costs like how the gold and silver miners have had to adapt that. I still see a lot of cash costs listed. Now, maybe those are just retail investor presentations. Maybe that's not the stuff that investment banks are getting or Sprott's getting. But, the retail investor, when they go and look at the presentations for these resource companies in the oil and natural gas industry, I think a lot of the management teams are being somewhat disingenuous or dishonest about what their actual costs are. And when I interview some other oil experts, they keep on telling me, oh, our cash costs are $10, but then our cash costs are $10 for Bakken oil or the other shale plays, but then they don't talk about the transportation costs, their exploration budget, so SG&A, so many other costs in there.
And they don't take into account their costs of capital, Jason. And by the way, the mining business is just as bad. When the gold and silver companies report their all-in sustaining costs, they don't talk about prior year write-downs in the first instance, and in the second instance, they don't talk about their costs of capital. In truth, in one sense, the gold companies are worse because the gold companies are trying to get us to use 5% as the discount rate for future cash flows, but non-investment credit gold and silver mining companies are paying all in 15% for their senior production credits. So if your cost of capital is 15%, how does it make sense to use a 5% discount on future net present values?
That's very interesting. So for our listeners out there who aren't familiar with the specifics of what we're talking about, if you were to make an estimate then for the mining companies, how much on a percentage basis would you say is the industry underestimating their cost by still?
Well, you have to do it on a case-by-case basis. If you're talking about a investment grade credit company, a company like Newmont or a company like Barrick, a company like Agnico Eagle, it probably makes sense to employ a 7.5% discount. That is what they would be able to obtain marginal funds for in the junk bond market. But the companies that have, recently secured production credit facilities that are based on the asset, not based on the balance sheet, are characteristically paying 15% for capital. So I would argue that 15% is a reasonable discount rate because that's the cost that they're having to pay in the market.
Wow, yeah, and if you're using a 15% discount rate, those discounted cash flows, they evaporate very, very quickly. It's less than 10 years.
That's
Be-
correct.
yeah.
It cannibalizes the out-year cash flow very quickly.
Yeah, so the gold and silver miners, they're going to need to focus on better margins going forward. We've seen that with some of the larger senior producers, with Barrick Gold recently focusing more on better margin products, better margin mines, excuse me, and improving their balance sheet. But I don't know if they're going to keep this up, because given the track record of some of these larger senior miners, they just have a track record of destroying capital.
Jason, in that regard, I'm a little optimistic. I suspect that the memory of the idiotic capital spending decisions that were made in the last decade are fresh enough in the minds of the officers and directors, and in particular, the memory of the CEOs who were fired for those decisions is fresh enough in their minds, that I suspect that we'll have another couple of years before the industry really begins to get stupid and profligate. And I think that we're going to have some earnings surprises to the upside in the gold mining industry in 2017. There are other things that are challenging, I think, but if we're looking for surprises in the 2017 timeframe, I think what will surprise people is the magnitude of the cash flow growth, at least the nominal cash flow growth among the better mining companies, as they enjoy the cash flow from higher gold prices and from some of the efficiencies which they have wrought in the last 3 years. And they, at least for 2 years or so, don't do stupid things with that cash.
Do you still think we're going to see a lot more mergers and acquisitions in the next couple years, as a lot of the ounces that were produced in reserves have been depleted, that we're going to see the mid-tier, so the juniors and the mid-tiers merge together?
I hope so. Certainly among the juniors, there aren't very many merger candidates worth considering. There isn't a lot of actual value in the space. Certainly, when a junior makes a real discovery, a good discovery, look at Reservoir, look at Kaminak, those things get taken up at eye-popping prices that, in fact, include some value for undiscovered resource. I'm more hopeful in the mid-tiers, although their cost of capital is coming down. The thing that really detracts from mergers in the mid-tiers is that neither management team wants to become unemployed. They become really salary preservation or maximization schemes. There's lots of room for M&A, and M&A would be very good. The sector's really, really overmanaged. And the truth is the general and administrative expense relative to revenue is way too high in the industry compared to other industries. It is estimated that if Barrick and Newmont were to merge, as an example, that the cost savings could be between $300 and $500 million a year. If you think that those companies are valued at 10 or 12 times EBITDA, that becomes what, $3 to $5 billion in capitalized value? And it's important to note that those savings don't deplete like a gold mine does. A $500 million a year cost savings is the equivalent of maybe the biggest gold mine in the world, except it can go on for 50 years. It's a big number.
Would you say that we're at current gold and silver prices right now, where we're going to see a good amount of new potential gold and silver, primary gold and silver mines come online in the next 2 to 5 years?
I do not. I think $1,300 is below the incentive cost for any meaningful supply additions relative to our current level of production worldwide. It's important to note, however, that may or may not have an impact on the gold price, given that almost all the gold that was ever mined constitutes supply. It's not like oil or copper where you use it up and it goes away. We take it from a hole in the ground called a mine, and we put it in a hole in the ground called a vault.
Yeah, that's a great point. I did a short video a couple months ago talking about my listeners. We have a lot of retail investors in our audience. They ask me for my opinion about junior mining companies, and I tell them, do you have a geology background? A lot of them don't. They watch some of these YouTube videos out there that are promoting crazy junior mining stocks, And I did a short video saying, a lot of retail investors shouldn't own any individual juniors without maybe going to either paying for a paid newsletter with trained geologists or being able to accurately read financial statements and look for management teams that are potentially cheating. There's so many things that can go wrong with a junior mining company on the way to building the mine. And then I talked about, Sprott, how you guys have a lot of these processes involved from geologists all the way through to looking at financial statements and preliminary economics assessments and pre-feasibility studies and feasibility studies. There's so many things that can go wrong at all of these steps on the way to actually building a mine and trying to generate free cash flow.
Well, certainly we think that skilled amateur investors can do very well. The problem is that most amateur investors don't spend enough time. You may recall in Toronto, Jason, that I suggested that the number of individual issues that an investor has in his or her portfolio should conform to the number of hours per month they're willing to spend studying. So if you're willing to spend 12 hours per month, you should have 12 juniors in your portfolio. You should read the annual reports. You should read the quarterly reports. You should read the filing statements. You should read the insider statements. If they are discussing geological concepts that you don't understand, go on the web and learn them. The second thing is, Jason, that the sophisticated investors, the ones who subscribe to the newsletters and who do the studying, would be well advised whenever they could to participate in the sector via private placement so that they got the warrant. Remember that investing in juniors is really a research and development business. You add value by answering unanswered questions. And the warrant gives you the ability, but not the obligation, to buy more at a fixed price over time if you get a yes answer. For many speculators, wanting to be in the market, wanting to capture the market beta, and it's been a great market to capture beta in, up 100% in 12 months, probably should involve a mixture of owning a junior ETF. We would, of course, prefer the Sprott Junior Miners ETF, SGDJ, and using that as a source of liquidity to take advantage of select special situations, particularly where you can grab a warrant in that special situation. We call that seeking alpha while capturing beta.
I think your Sprott Gold Miners ETF and the Junior one are both very good products for the retail investor. I think they're going to rapidly displace GDX and GDXJ. There's a lot of problems with both of those. We're talking at the Sprott event how they had to rebalance their portfolio for GDX, and they had to buy 10% of a stock in one day to rebalance, and they screwed it up. So it's just ridiculous.
A wonderful problem to have, of course, but what you say is true. The very size of those vehicles begins to distort both the vehicle and the market.
Yeah, and the other thing about the retail investors is, you brought up due diligence. I agree. People should be doing that type of due diligence. That's what it takes to succeed over the long term without, being a lucky speculator, having a lot of luck involved. If you want to actually be a skilled speculator on juniors, you need to do the type of due diligence that you talked about. But unfortunately, a lot of the retail investors, I asked them how much research they've done on a junior, and it's like, well, I saw this YouTube video and there was a commercial about it, or, oh, this was brought up on, a couple... there was one article about this junior mining company, and then you didn't see in the bottom, in the fine print, that, someone was paid to write up the article about the junior mining company.
Well, that's correct. Human nature is that we want the easy way out and that we respond emotionally rather than empirically. And I know, Jason, that if we did a 45-minute video on how to pick gold stocks, that it would draw less well for you than if you had a fancy headline saying billionaire Rick Rule, inaccurate, by the way, and his top stock pick. The truth is that's just the way things work. It's unfortunate, but it's also the way things work.
Yeah, I completely agree. Now, you talked about the Chinese looking on the prowl to invest in gold mines. Sprott has been hired by the largest independent Chinese gold mining company or non-ferrous gold mining company to do due diligence on resource projects?
Not exactly. We manage money for them. We manage equity for them in the gold mining space, and we've been very successful. We have also, on a couple of occasions, introduced them to companies as investments that they have made large investments in. The best known case of that was, of course, Pretium, where they became very large shareholders.
Oh, very good. Now, you talked about this new joint venture you have with the ICE exchange. That's from the book Flash Boys that Michael Lewis wrote about. You guys are attempting to take away some market share from the LBMA and the COMEX and have gold futures contracts settled in physical gold. When do you think this product's going to launch?
That's a great question, Jason. I don't know the answer to that. Understand that we're trying to reinvent the gold market. We are trying to put in place a product where physical gold will be stored at the Royal Canadian Mint, and it will be represented with, in effect, certificates, buttons, tickets, whatever you want to call it, that will be authenticated and transferred via blockchain technology rather than conventional settling technology. That would give us the ability to have gold really truly as money again. This instrument would be redeemable, unlike other virtual instruments. So it would have the effect of being a medium of exchange that was simultaneously a store of value, with the transaction costs that you see in the market being a fraction of what they are today, to the point where you could transfer gold into dollars or dollars into gold. You could make fractional payments against your own gold holdings, and so use it to buy, a carton of milk at a 7-Eleven. There's no guarantee that we're going to be successful with this, but the possibility of it is good enough, and the market size is enormous enough, and frankly, the benefit to mankind is substantial enough that this is the kind of investment that Sprott has to make. If it succeeds, it could be absolutely gigantic.
It looks very similar, at least certain aspects of it, to gold money. But from talking to you guys at Sprott in Toronto, it sounds like you're going after the larger pools of capital, the institutions who trade futures contracts and pension funds and larger pools of money rather than gold money, which does have high net worth individuals. But gold money also caters to the retail crowd, too, who want to use gold for, grams of gold for smaller payments.
Gold money is a here and now product, and it is a superb product. We were large and supportive shareholders of gold money. Understand that gold money is a here and now product. It exists. What we are trying to do is something much more profound, and we may or may not succeed. If we succeed, the utility that we generate will be larger and different than the utility with regards to gold money. We're talking about really destabilizing the entire gold market rather than putting a settlements position in place. And importantly, we would authenticate and settle via blockchain technology, which has the potential to be much cheaper and much more scalable.
Well, I wish you guys the best of luck at this. You're going after a very large market. There's a lot of profit potential here, a lot of long-term growth, and I'm a Sprott Inc. shareholder, so hopefully I'll be collecting dividend payments as you guys are successfully able to grow this out.
If we were successful, I suspect that your dividend on an annual basis would exceed your basis in the stock.
That would be good for me. I would be very happy with that. I really enjoy the Sprott Inc. company. You guys look at things a lot differently than most other people in the commodities markets. A lot of people, the Wall Street research for commodities market stuff is Keynesian economics. It's not looking. It's not talking to geologists a lot. It's a lot of basic Wall Street stuff.
What I think people need to know about Sprott is that the largest shareholder of the company is still the chairman of the company and is still the largest customer of the company. There is a person at Sprott named Sprott who guarantees that we stay what it was designed to be. Many of the largest financial institutions in the world don't have any adult supervision. The management team don't have any ethical identification with the product, and they don't have any consequences really for being wrong. They're not large shareholders. At Sprott, that's very different. When we talk about the over-leveraged nature of the financial services industry, when we talk about the over-leveraged nature of governments, we eat our own cooking. We have $300 million in working capital, no debt, and we generate free cash at the bottom of the worst bear market in years and years and years. We're a very different kind of company.
Yeah, I actually think Sprott Inc. is one of the safest investments people can make into an actual getting gold and silver exposure, and then you get a dividend, you're paid to wait. So I think it's a very safe investment into gold and silver exposure for more conservative investors.
Well, thank you for that observation. We try to be just that.
Well, I want to ask you about the Federal Reserve. You know, these academic Keynesian PhD economists, they just keep writing these crazy papers. Things just keep getting crazier and crazier. They're like the crazy uncle that we have, you know, that can barely hold a job, that has a gambling addiction. And every time, you know, that one of their policies screws up, it just seems like they want to double down on the same type of policy. It seems like the Federal Reserve is intent now on starting to buy U.S. stocks in the near future and corporate bonds, maybe even implement negative interest rates on bank depositors. As someone who's more libertarian leaning, Rick, what do you think of all this?
Well, I don't think you have to be libertarian leaning, Jason. I just think you have to be able to do arithmetic. My criticisms would echo yours. I think they may be well-intentioned. I don't know them. I'm concerned that Janet Yellen has such an enormous influence on the economy, but she's never had a job. You know, all she's made all her life is policy. She's never met a payroll. She's never done anything like that. So I sort of think that she's disconnected to the world. We're in a strange place now, Jason. I'm substantially older than you. But at your age, if you had told me that the government could get away with making a promise that if you gave them money, they absolutely positively guaranteed without fail to give you back less. I mean, I realize that's been the reality for a long time, but the fact that they can get away with that promise is astonishing. The truth is that if quantitative easing, if printing money out of thin air and buying private assets with it is a really good thing, then the Constitution should be altered to allow you to print Jasons and me to print Ricks, and exchange them with people based on our good faith and credit so that we could buy stuff with it. On the face of it, this is absurd, but this is something that we've bought into. And when I say we, I don't mean you and I, Jason, or many of your subscribers, but the truth is that the broader society would like to believe that the world is in good hands. They would like to believe that the big thinkers of the world, the Yellens, the Carneys, the Obamas, the Merkels, stick-handled us through the financial crisis of 2008 and through deft maneuver saved the world. What they in fact did was finance it. That's what they were able to do. Our problem, I think, Jason, is that people around the world want to believe that liquidity is a cure for insolvency. It's as though somebody had $1 million in debt and $200,000 in assets, but they didn't feel bad about it because they had $10,000 in their pocket. In other words, the reckoning was down the road. They could buy their whiskey today with cash.
Those are great points. Janet Yellen also has a couple pensions that are going to kick in. Whether if Donald Trump wins the election, she'll get fired. She'll be able to retire comfortably on those government pensions. Her probably speaking fees that Alan Greenspan and Ben Bernanke are getting, she'll probably be able to get similar bribes or speaking fees from Wall Street and other people. And I agree. I think it's incredibly immoral for these central bankers to just decide that, you know, for the good of all the citizens, for the good of the economy, we're going to try to keep the asset prices higher. You know, I'm a younger person. I'm barely a millennial. I was born in 1982. And, you know, I want cheaper assets. I want to be able to buy a house at a cheaper price. I want to be able to buy stocks at a cheaper price. So for them to try to force the stock market higher, keep real estate values higher, they're not doing me any favors. They're creating, you know, class warfare of baby boomers versus the millennials.
We're doing something very different too, Jason. And on behalf of my generation, I thank your generation. We've made a bunch of promises to ourselves. I don't mean you, I mean we, my generation, made a bunch of promises to ourselves, and we're going to give you the bill. When people look at the on-balance sheet liabilities of the U.S. government at $20 trillion, the number has become so large, 20 with 12 zeros after it, that it's incomprehensible to most people. Sadly, it's very real. But it gets worse than that, of course, Jason. the estimates vary as to what the unfunded liabilities, the off-balance sheet liabilities of your generation are. And I've come to understand in the mid-60s what those off-balance sheet liabilities are. They're old folks like me, not like me right now who makes a lot of money and pays a lot of tax, but old folks to be sure, people who are or will be collecting Social Security, Medicaid, Medicare, all of the promises that my generation has made to itself, our continued insistence in living beyond our means, and our willingness to stick you with the bill. So on behalf of my generation, Jason, thank you very much for the sacrifice you have yet to make.
Thank you. I feel no, thank you. But unfortunately, we're stuck in the system. Obamacare, Social Security tax, these things are all basically Ponzi schemes where they're going to keep taking more and more money out of our paychecks going forward if we're employees. Obviously, if you're in your own business and you're an entrepreneur, you're not going to have to pay the same taxes that employees do. But it's very frustrating. I see, unfortunately, more inflation and taxes going forward from our overlords.
Well, I look forward to your generation voting no and cutting us off.
Unfortunately, Rick, I think most of my generation prefer socialism and Bernie Sanders. They don't know even what real capitalism is because, in these government schools, they haven't been taught what it really is. So maybe they'll wake up and maybe they'll go to the internet and figure out what's really going on. But I don't really see that from a lot of my contemporaries right now.
Well, to paraphrase Mencken, the voters usually get what they deserve, often good and hard.
Well, hopefully it's not Hillary Clinton because that's really scary, some of the stuff she's been promising.
I have no preference.
Yeah, I've gotten in trouble for saying that I'm going to vote for Gary Johnson, but I mean, I hope Trump does beat. I like Trump a little bit better than Hillary Clinton because at least it looks like Donald Trump doesn't want to start World War III with the no-fly zone in Syria. But, Donald Trump has enormous problems, too. I mean, I don't like Gary Johnson that much either, but maybe the Libertarian Party in the next election with more campaign financing, they could find a better candidate than Gary Johnson.
Your lips to God's ear, Jason.
Well, Rick, before I let you go, my listeners, I'm sure they want to know about uranium. You were talking in Toronto about commissioning a very extensive uranium study. How is that coming along?
We are doing just that. We've talked to many of the big players in uranium to get a sense of the market. And when you talk to 9 big players, what you find out is that nobody has a good sense of the market. So we've decided to construct our own. We're trying to commission a study that will, as an example, look reactor by reactor at 422 operating reactors and 52 under construction or permitted, and figure out what their scheduling and financing needs are, figure out what the demand side of the uranium business is going to look like. At the same time, we're trying to look at where the above ground inventories are now, who owns them and what their motivations are. In other words, what is going to come out, and look at the mines and deposits around the world and try and figure out what the cost of production and the schedule is going to be. We want to get a real sense of the uranium market, which will give us a sense of when we're going to have a rebound. And Jason, I say when, not if. The truth is that the consensus, which may or may not be right, is that the global cost of producing uranium, including cost of capital and adding back prior write-downs, as we described earlier, is between $60 and $65 a pound. So you're making the stuff for $60, you're selling it for $20, you're losing $40 a pound and trying to make it up on volume. Either the prices go up or the lights go off. What we need to determine is when and when we have to act. In the context of that study, we are going to look at about 20 companies that are either uranium producers or could be viable at market clearing or market incentive prices for uranium, and try and figure out what the best of those 20 are. We're going to try and select 5 or 6 that we will concentrate our efforts on. It is likely by the time that this study is released, middle or end of next summer, that we will still be 2 years early in terms of a rebound in uranium and uranium equities. But my own experience is, with an opportunity as large as the uranium opportunity is, that being 2 years early, particularly if you can provide financings for those companies so that they can sustain a further 2 years of revenue drought, will pay very high rents indeed when the market turns around. You may remember our discussion in Toronto, where I said that in the last uranium bull market, although we were very early, we basically owned the float on all four of the viable uranium juniors before the market turned. And the worst market response that we got, if my memory serves me well, was 22 to 1 over 6 years. So we believe that the expense of the study is worthwhile. We believe that the time that we have to wait is worthwhile, because we believe the answer to the question that we're asking begins with when, not if.
Yeah, I agree with that. The timing of the uranium, when to invest in it, has proven very difficult. A lot of people have been early on that. How have the uranium producers, in the meantime, since you've been telling me basically they've been producing and losing money, how have they been able to survive? Are they hedged? Are they, just selling barely enough equity to cover costs and keep the lights on? How are they even surviving then if they're losing that much money on each pound of uranium they produce?
Well, the three answers to that really. Some of the producers, BHP and Rio as an example, are able to subsidize their uranium business with other sources of income. The high-cost Russian production is similarly subsidized. Kazatomprom is the world's largest and lowest cost uranium producer, and they have three deposits which make reasonably good money at this price, although it's not sustainable, and they are beginning to constrain their sustaining capital investments. Cameco is a mixed bag. Their ISR production, I think, loses them a fair bit of money, but things like Cigar Lake, on a purely cash basis, not including the sunk capital costs they have, do okay. With regards to the junior producers, what they're doing is cannibalizing capital that they either made in the uranium boom or were able to raise in the uranium boom. There is nobody that I'm aware of other than China Nuclear, Kazatomprom, and Cameco that have any production that is sustainable in this price environment, left on its own, unsubsidized.
Oh, thank you for that analysis. That's good. I'm sure our listeners will real appreciate that. If they're interested in maybe getting your uranium analysis when it comes out, that report, they can contact your website at Sprott. I have one last question before I let you go. It's about the copper market. Obviously, I think the global economy is not really doing that well. Copper is called Dr. Copper. It's normally a good indication of the health of the global economy. We've had the copper price go around the $2 per pound range for a while now, but we haven't, I don't think we've seen a lot of bankruptcies yet for copper producers. We haven't seen a lot of copper mines necessarily come offline yet. Do you think we're going to see a big bust in copper in the near future?
I don't know if we're going to see a bust in the copper price, because the copper price is well below the incentive cost, which would be required to bring new mines on production. What we are starting to see is a dramatic reduction in sustaining capital investment and investment in new productive capacity. The largest copper mine in the United States by far is a mine called Bingham Canyon, which you can see when you fly into Salt Lake City Airport. We use on a global basis one Bingham Canyon a year worldwide, and we are not building one Bingham Canyon a year. When this will turn, nobody knows, but we're seeing real strains for the producers. We're seeing ZCCM, the National Copper Company of Zambia, experience real hard economic times. You're seeing Codelco, the largest copper producer in the world currently, controlled by the Chilean state, basically out of money. The much talked about expansion of Olympic Dam, one of the biggest copper mines in the world, has been put on indefinite hold by BHP. So you're starting to see supply destruction in copper. The business is substantially overcapitalized still, so supply destruction can go on for some period of time. But make no mistake, when we get deep enough into supply destruction, what happens then is that the stage is set for an absolute price spike, because once you shut this production down, it takes 5 or 6 years to restart it. So an increase in copper price isn't met by a supply response from the producers, because they've cannibalized their ability to produce.
I'm really surprised we haven't seen more bankruptcies yet, but I guess, like you said, during the last cycle, during the bull market in copper, a lot of the copper producers were able to overcapitalize themselves, and they've creatively, I guess, figured out ways to cut costs. A lot of these copper producers had their mines hedged for at least 3 years. So they had, some cushion with the hedging to lock in higher cash flows. But, those hedges should be coming offline in the near future. I was just really shocked. I thought when the copper price hit 2 and stayed there for a while that we would just see more bankruptcies from primary copper producers.
Well, don't forget also, Jason, the impact of artificially low interest rates on capital-intensive businesses. Many of the same business pro formas that called for $3 copper were calling for 8 or 9% senior credit rates. And if you are expecting to pay 8.5% and you're BHP and Rio, and rather than that you're paying 4%, they have been extraordinarily lucky as big consumers of capital to be facing weak copper prices at a time when their cost of capital is at historical lows.
Do you think that's the same situation that a lot of these over-leveraged U.S. shale producers have been in, how there haven't been nearly as much bankruptcies because they're getting a lot lower interest rates than they expected in their financial projections?
On steroids. Their equity cost of capital, as a consequence of the expectation that the market had for them, it wasn't low, it was negative. In other words, they raised capital at substantial premiums to what they were worth. The senior production credit facilities that they enjoyed were very cheap, and the access to capital that they enjoyed in the junk bond market was probably more excessive than at any time in the history of the conventional oil industry.
Yeah, that's a great point. I know there was a lot of pension funds in the U.S. and also insurance companies that in the past they never would have went into the junk bond market and started buying U.S. shale debt, and yet they are large holders of it right now. So I think they're going to end up being bag holders.
I have a suspicion that you're exactly right.
Well, Rick, I really enjoyed this conversation. If our listeners want to find out more about your company and potentially be a client for your firm, how do they do so, and what type of services does Sprott Global provide?
The easiest way to find out about us is to come to www.sprottglobal.com, our website, and explore it. Among other things, there are 200 hours of instructional material, things like the Mining Investment College that we did with the Colorado School of Mines on the site, which are absolutely for free. You can also subscribe to our blog, Sprott's Thoughts, which has the best ideas of the Sprott organization, plus many people that we interview. I know you'll get your money's worth out of that because it's absolutely free. But a special thing that we have for your listeners, Jason, is that I personally will rank their natural resource portfolio. If they email them to us, you have to include the name of the stock and the symbol. Email that to me personally, RRULE at sprottglobal.com, and I will send you back a numeric ranking 1 through 10 of your natural resource stock holdings as we at Sprott see them. You can also call us at 800-477-7853.
And you guys have a team of geologists on staff. You look at the financial statements. You guys do extensive due diligence on a lot of your picks. You guys also focus on getting people into private placements like we talked earlier in the interview, right?
Yeah, we have a deep network of financial analysts, geologists, engineers, earth scientists, that type of thing. We also employ an army of third-party consultants. We are very large consumers and distributors of private placements, meaning that we manage almost $1 billion in equity in the junior natural resource space, much of which is geared to private placements. And we believe, as a consequence of that we allow our retail clients to participate alongside the largest single investor in junior resource private placements.
Excellent. Well, thank you for your time, Rick, and hopefully we'll have you back on again soon to talk about the resource markets and when gold and silver resume their bull market.
I look forward to it, sir, at your convenience.